everyone. Welcome to our webinar, The Emergence of Tokenized U.S. Treasury Bills. This webinar is co-organized by Matrixdock and DigiFT. I'm Chloe Han, a Senior Manager at Matrixdock. I'm happy to be your moderator for this webinar today. We have two panelists with us today who will be sharing their insights. Could you please briefly introduce yourself to our audience, Marcus?
Yeah, thanks, Chloe. So my name is Marcus Thielen. I'm the Head of Research and Strategy at Matrixdock. That means we are analyzing the current market environment, we're analyzing protocols, we're sending out investment ideas, and just analyzing how the market is basically evolving. So that's what we do on the research side for Matrixdock.
Great, Ryan.
Hi, thanks, Chloe. This is Ryan. I'm the lead of research and innovation at DigiFT. So most of our research topic is about RWA and its issuance model, and as well as the crypto world. And to put it simple, DigiFT is regulatory compliance DEX for STO, and we are currently the first and only security token DEX enrolled in Monetary Authority of Singapore in its fintech regulatory sandbox.
Great. Before we delve into the main topic, it would be great to gain a deeper understanding of the current market condition, to understand the reason behind the rising popularity of tokenized U.S. Treasury bills. How do you perceive the current market status? We can talk about macro market condition, crypto fundamentals, and recent DeFi activities. Marcus?
Yeah, thanks, Chloe. So of course, the most important topic is really that 2 years ago, the crypto bull market was all driven by the yield farming craze, plus to some extent NFTs. But I think the biggest driver was really the yield farming craze that came out of the zero interest rate environment that really markets have gone through for like a decade. When central banks cut interest rates to zero, everybody got used to getting 0% basically on their values. So it just became about the capital appreciation of your holdings. And what happened then when the yield farming craze started, and I think it was sometime in June 2020, really around, suddenly, of course, these protocols were paying a large amount of yields, and this is when people moved from one protocol to another. And of course, this caused a lot of usage on the Ethereum blockchain, as well on others, but of course, predominantly on the Ethereum blockchain. And this is when revenues really started to spike up. You could actually value how much is Ethereum generating versus the market cap. So you could, come up with some like earnings yield even. But of course, the market has fundamentally changed. Now transaction volumes is still relatively low. And this is why I think we can still argue we are sort of like in a bear market for crypto. And then, of course, the question is, what do investors really make with their holdings, right? Are they happy to just have like some, direct exposure without really making any yield? While the TradFi market, that's really generating, suddenly like 5% yield, and this is really the contrary what we have seen just like 2 years ago. So, and I think that's a little bit kind of the use case for crypto offering higher yield is no longer there, and this is why we think the market has actually fundamentally changed, and this is why, for example, RWAs have really been the strongest growth projector in the market, right? And of course, we know that the central bank in the US has hiked interest rates. This has hurt the crypto market overall. But I think, there's a saying that there is always a bull market somewhere. And I think the bull market right now is in RWAs.
Right. And Ryan?
Yeah, pretty agree with Marcus. We are currently in a bear market. The bull market was 2 years ago. At that time, DeFi was a very innovative concept. But now, in the current DeFi space, I don't see many innovations right now. So I think there's not many traction to attract money from outside of the DeFi space. So just add some details. In terms of the yields, I think DeFi yields are mostly coming from three types of activities. One is from staking, which is the new token issuance, like the ETH staking. The second one is from trading, which might be the trading fee from Uniswap. And the third one is lending. And currently in a bear market, all those activities are at a very low level. So I think also agree with Marcos. Recently, real world asset tokenization might be an alternative as to attract investors. That might be the reason why tokenized U.S. Treasury tokens or other similar investments attract attention recently with very huge growth. Also, a lot of players inside this area, like Matrixdock. I believe you guys will talk more about your technology solution later.
Yes. Yeah, we looked through the current market condition and risk and opportunities, especially that like there was DeFi summer, and then now like we lack of innovation in the DeFi side, and then the yield rates are not attractive as before. So let's deep dive into the main topic. So how can tokenized U.S. Treasury bills benefit investors and institutions in digital asset markets? We can review various perspectives. Marcus?
Yeah, so one theme that we have been quite active almost for the last, I guess, 1 or 2 months is that we were a little bit concerned with the market. And then, of course, we have been, we have already, returned something like 75% year to date for Bitcoin. So we were suggesting to investors that they can lock in their profit, and combined with very low volatility that we have seen in the market, because we have been just basically like range trading. The market has been, in terms of like the Bitcoin market or the Bitcoin price itself, has been really pinned around like 29,000 for several weeks now. And this has caused actually volatility to drop to 17-18%. This is for realized 1 month volatility. Implied volatility has also dropped to sort of like mid 30s. But the case that we were making is because there's all these like large overhangs of risk that we see in the market. There's some friction, around China. So the Chinese RMB is actually making the lowest level since 2007. Treasury bond yields are climbing, so rising cost of capital. That's like the highest level since 2008. So I think there is a lot of friction in the market within itself. And this is why we're suggesting, if volatility is so low, it actually makes sense to just buy, for example, if you're bullish, to just buy upside calls, just use 3% of your capital. This is how much 1 month at the money call costs. So if Bitcoin rallies, you participate, but you only have 3% of your capital at risk. Of course, those calls expire every month. But if we have a sell-off, basically it allows you to have 97% of your capital on the safe side. And the question is, of course, what you do with your 97%. And here, of course, the example is other stable coins like USDC or USDT that really not paying investors anything because the company's behind it making the money. And I think this is where, investors were pretty indifferent about it, up until, I guess, beginning of the year when suddenly interest rates were going higher last year, and people, with a lag started to realize, hey, here's like 4 or 5% to be made, just like risk-free, basically, or near risk-free. And this is where suddenly this RWAs have really become in focus, because if you put 97% of your capital in RWAs until end of the year, you get sort of like 2% back. And so you end up with 99%. And if you buy like a 3% call, you can still participate in the market, but you have actually the downside protection of your invested capital. And I think this is where suddenly like structured products, which are very important for TradFi and the private banking side, when interest rates are higher, becoming really the focus of investors. And I think we are going through something similar for crypto right now.
And Ryan?
Yeah, also in terms of the crypto world, I think currently RWA DeFi protocols are looking for other yield source, especially so those yield source especially are RWA. So I saw a lot of DeFi protocols are doing that. So just give some details, like take Matrixdock as an example. Recently, Matrixdock just raised its DAI saving rate, which we call the DSR in short, to a very high level. So that yield is even higher than US Treasury. So basically, those yield given to those DAI holders are coming from RWA, and the Matrixdock's lending protocol is called Spark protocol. So So why the MakerDAO can offer such a high yield? It's just because their underlying assets, to be honest, it's from the U.S. Treasury, but the MakerDAO is using a very complicated structure to buy the U.S. Treasury bills because it's a DAO, not a company, not a legal entity. So basically, they build a trust structure, use three entities to be their holder, enforcer, and administrator. So the whole process costs them $2 million US every year. But if this process is extremely complicated and very costly. They even have another entity to pay the similar price for their U.S. Treasury. But if we can think from another perspective, if we have some like professional token issuer to help us tokenize the U.S. Treasury bill onto the blockchain, then it's very easier for other DeFi protocols to adopt RWA. That's my point. I think in the future there are gonna be more and more token issuer to help us tokenize some good RWA assets onto the blockchain.
Got it. Yes. Like based on your insights, like Marcus mentioned a low volatility, the rising level of the cost of raising capital, and also for the DeFi side, those like DAOs are looking into could potentially look into those tokenized RWAs for their like better operational procedures. And there are many other tokenized real world asset issuers talking about on-chain transparency. So how do you see the proof of reserve services on tokenized real world assets? Is it a game changer, do you think, Marcus?
Yeah, I think the key point is really the transparency, and I think there has been a lot more scrutiny, among the wallet users and among the protocols. What kind of assets do they hold? I mean, everybody is just very focused on some of the large protocols, what they're holding. Do they really have the assets? And this has come, of course, under a lot of scrutiny, especially after some of the cases that we had like last year. And I think here the case is, for example, a company like Matrixdock, has integrated with Chainlink POR, and I think this is very key because it has some automated on-chain verification. And you have number one, you have the tokenization of the RWA smart contract, which can confirm then the collateralization of the underlying assets. And number two, you can really streamline the whole process and has increased efficiency and reliability for investors. And I think this is what investors are looking more and more for. And this is where they have the confidence that actually, well, yes, they have actually the underlying collateral, they have the underlying treasuries, and this is where I know where the yield is coming from, because you can easily see what the implied yield is that you're getting right now versus what is the yield of, for example, the treasury market. And in a lot of cases, as you have seen over the last kind of like 12, 18 months, other yields were promised. And of course, there's also some other tokens in the market that promised, to attract some capital that actually promised like double the yields. But of course, here the question is, how sustainable this is. And of course, those yields have actually been slashed down now. It was more like a marketing trick. But I think investors don't want to fall for these marketing tricks anymore. I think investors want some, stable source of the yields and really the transparency that those yields are being, generated on the collateral that's really available there for investors.
Yes, I definitely agree with you in terms of there's like the investors looking into stable source and of the yields, and also want to have like transparency into like how the yields are given from the underlying collaterals. And anything to add, Ryan? And also you can talk about other than on-chain transparency and other benefits that the tokenized reward assets are giving.
Yeah, I just want to add two small details from my side. One is still about the on-chain transparency. One thing while we are building a decentralized exchange is that we think on-chain transparency gives our investor a very good information disclosure, which can help us protect the investors. So basically, blockchain is an open and permissionless, transparent ledger. So you can easily go to EtherScan to know who's holding those tokens. So anyone can read and analyze the data in a timely manner to know who might hold the majority of the token. So in terms of that, it gives more information that's closer to the investor, so they can decide whether to buy or not to buy. Another point I want to add about the benefit of using RWA tokenization is that actually it can give a better user experience for our investor. If we take, for example, if we use the traditional financial service, there's a lot of fraction between all those applications. If you want to buy some security token, buy some security from exchange, you need to deposit money from a bank, then wait for T+1, then you trade, then you wait for the settlement. It might still take 1 or 2 days. Then after you finish all of that, it might take 1 week. But in DeFi space, once you get a token, you can very easily trade on those decentralized exchange. It only takes you several seconds. Then you can just go to lending, go to staking, go to all kind of DeFi protocols with a very good user experience. Just connect your wallet, and everything can be done within 1 minute. So I think that's the power of blockchain. That's also why we think tokenization might be the future.
Great. Yes, so the part that you mentioned about the great flexibility comes after those real world assets being tokenized, and then they can actually navigate the DeFi space with this assets, and then yes, that's actually there are a lot of those tokenized asset issuers are talking about like on-chain transparency and such flexibility in the user experience as well. And since we are experienced, we're talking about the benefits of tokenized real world assets, so maybe we can now talk about what are the challenges there and what are the opportunities path ahead. Marcus?
Yeah, of course, the challenges is of course on the on the legal side, the enforceability of some of those contracts. Is the collateral really there? As we talked about a little bit earlier already, that there needs to be some strict oversights, some trust, some KYC, especially when you go down the route of tokenized real estate. Are there some restrictions? Are there some, foreign ownership restrictions, for example? All these things, come to mind. And again, I think the key question will be on the legal side. It will be on the KYC side. But if you have really counterparties like trading with each other that have properly done the KYC and agreed on all of those terms and have the trust among each other, I think then of course there can be a lot of seamless trading. And I think this is then when basically we take out a lot of those extra cost of maybe stamp duty of property. We take out cost of extensive notary cost and so on. This usually for property it can easily add up 5, 6, 7, 8% per transaction, and I think this can really minimize, so that we can see that there can be really billions of savings for for investors, and plus the settlement can be a lot faster, right? I mean, these days a real estate transaction usually takes 2-3 months before it closes. But if it's tokenized, it can close within an hour, for example, right? So it can go actually quite quick. And I think, time is money, as they say. And I think this can be a really big beneficiary there. So, and of course, the other aspect we have, the other aspect of risk is really, as I was saying, the reinforceability. Who is there to oversee this? Is an arbiter, somebody who can be, to step in to kind of solve some of the cases. So there needs to be some good legal oversight. And if that's not the case, then you need to have really the parties trading with each other that trust each other.
And Ryan?
Yeah, agree with Marcus. There's a lot of challenge from the legal side. I just want to add some point from another perspective, which might be the technology and the product side. So we are also doing some product. We are facing some customers, and what we saw is that many customers, especially from those traditional finance customers, they just don't understand why we need to hold a crypto wallet. So that's what might be one of the biggest problems for the crypto to go to mass adoption. Because if you want to hold your assets, you need to have a wallet, which means you need to take care of your own private key. And also, if you want to make some transaction on blockchain, you need to pay gas. So, those two questions, I think, might be the biggest issue for the user experience side. Although crypto has a lot of benefits, but those are still the issue. So I think in the future, maybe some smart contract wallet solutions or gasless solutions can help us solve those issues to give user a better experience. Then we can say real world assets, tokenization, crypto can go to the mass adoption.
Great. Thank you so much for your insight today. Today we have covered the popularity of tokenized U.S. Treasury bills. It's definitely included in a tokenized real world assets in a bigger term, and how investors and key market participants are responding to the trend and then challenges and the path ahead. Many thanks to Marcus and Ryan for sharing their valuable insight today. And we believe the webinar has offered a deeper understanding of the topic. Remember that your journey doesn't end here. Stay connected and learn more about tokenized real world assets. Thank you very much, everyone.
Thank you.
Thank you.